Hey everybody, it's Mike over at Taxes and Bricks. Welcome to episode 40. Today we're going to touch on something that's actually kind of been a little apropos lately in the last few months and last year or so, and that is the tax implications of selling your primary residence. But first, if you like this kind of content, go ahead and hit that like button. Definitely subscribe and share content with your friends. Leave a comment, leave a question below. I always answer and respond. Also going to throw up a little disclaimer here since we're going to be talking taxes. So, stay tuned while we pay the lawyers.
This video is rated TAX and contains occasional ramblings, mild attempts at humor, self-deprecation, irreverence, brief numerical examples, and adult tax and accounting advice that may not be suitable for all taxpayers. Viewer discretion is advised. Before following any of the advice in this or any of our videos, you should always consult with a tax professional. Thank you.
All right, so I've actually tried to record this video a couple of times, and I tend to ramble a lot because there's a lot to cover here. So I'm going to try and condense this down into like 15 minutes. I don't know I'm going to be successful on it, so forgive me. But there are tax implications when you sell your primary residence. Whether you pay taxes or not, you still have to report the sale on your income tax returns. You have to report when you bought it, what you paid for it. You have to report what you sold it for and when you sold it. And then in order to really figure out any of the actual profit, you can use things like the closing costs when you bought it, the closing costs when you sold it. You can use any closing costs from refinancing during the period of time when you owned it. And you can use any major improvements to the property, an improvement being defined as something that either enhances or is intended to enhance the value of the house. So something like, a whole new kitchen would be an improvement. Repairs, not so much though, at least repairs while you own it. Repairs incident to or as a result of actually trying to sell the property, those are allowable as kind of make-ready costs against the profit, but ultimately, the air filters for your HVAC or light bulbs or doorknobs or things like that that you replace throughout the course of ownership, you don't get to use those against the profit. Okay, so do you pay any taxes when you sell your primary residence? Well, it depends. In most cases, in most of the situations I see, the answer is no. And the reason the answer is no is because the IRS has something called Code Section 121. And Code Section 121 says many things, but one of the big things that it says is if you are a single individual and you sell your primary residence and you both owned and lived in your primary residence for at least 24 months out of the 60 months prior to sale, you may exclude as a single individual up to $250,000 in profit. Same rules apply, but if you're married, okay, we're talking about $500,000 or $500,000. Okay, so there's a big kind of cushion of gain or profit that you could have before you end up having to pay taxes. And as I said, most people, I just don't see them making these kinds of profits when they sell their house. It's not impossible. I have seen it many times before, but it's just not super likely. So a lot of times people will say, oh, well, nobody ever pays taxes when they sell their home. Well, I mean, people do. And regardless, you have to report it. Okay, so it's not like, well, I bought my house for $400,000 and I sold it for $6,000 and I'm single. I'm well below the $250,000. I'm just not going to bother. No, you still have to report the sale. I mean, that is required. So don't just go ahead and think, oh, I made less money, I don't have to do it. Okay. What are some of the weird, wonky rules with respect to this? Well, let's talk a little bit about how often you can do this, because that's kind of a big deal. You can't do it every year. And you're thinking to yourself, well, of course you're going to do it every year. You're going to buy a house and sell it every year and make a profit. Well, no, you can't do it every year in the sense that, let's say, this year, 2022, you were to sell your primary residence and the rules stated that you don't have to pay any taxes. You fell in the time test, you fell in within the profit range, you're good to go. And after you sold your house in 2022, you moved into a second home, okay? Maybe it was something that used to be a primary residence and you moved out of it, and maybe you were renting it out for a little while, and so you move into it, okay? And then you try and sell it, okay? And maybe by the time you kind of look at it, you've passed the time test on that too. And so you think, well, I'm just going to sell that in 2024 or 2023. No, you can't do that. You can't do this every year. You have to wait 2 full years to sell another property before you can use the dispensations under Code Section 121 again, okay? So you can't do it every single year. So, I mean, think about it. If you have like a line of properties, you can't just like keep moving into them and, sell, provided you qualify. I mean, you'd have to live there 2 years. So, I mean, I guess in theory you might qualify, but we're going to talk about that as well in a little bit, about why if you move into a second home or a rental property, you may not get the full 250 or 500, okay? What are some of the other exceptions? Like, I hear this a lot. People will call me up, especially here in the DC area, which is really transient. I mean, people are just, they're here one day and gone the next. Somebody will come, they'll set down some roots, they'll buy a house, and then poof, government job transfers them across the country or across the world. Maybe they're in the military, maybe, I don't know, maybe they're just, here one day and gone the next. And it happens everywhere, but especially in DC. Well, job transfer, involuntary job transfer, is a reason that you can still exclude some gain from the sale. Not all of it, but some. That's a reason you could, have an exception to the ownership and use test of 24 months out of the 60 months. Divorce, kind of involuntary, although I would suppose in some cases somebody was probably asking for it. But divorce, multiple births from the same pregnancy. Let's say you had a house and you bought a house and maybe you got pregnant, and maybe the house would have been fine if you just had one baby. Maybe it was a 1-bedroom or 2-bedroom place. It would have been fine for a little while. But, well, lo and behold, go to the doctor, and the doctor's like, hey, congrats, you're having 3 babies for the price of 1. Woohoo! Well, 1-bedroom or 2-bedroom house you got's probably not going to work. And if you haven't owned it or lived in it for 2 years, you can still sell it as a result of that and exclude some or potentially all, I guess, of the gain, depending on how long you've owned it and how much you made. Acts of terrorism, natural disasters, certain, elements of non, sort of involuntary actions that might happen to you. Those kinds of things. The death of a relative or a loved one who's claimed on your returns. That's also an exception. Certain financial hardships, etc. All reasons that you could potentially get away from a house and still not pay taxes on all or some of the gain, but have not met the requirements to live in the house and own it for 24 out of the 60 months prior to sale. Let's talk a little bit about sort of second homes here, because I think that it's really important to talk about this, because I actually hear this a lot, mainly from my clients who've been working for a long time, and, worked real hard in their lives, and maybe they owned a home where they raised a family for years and years and years and years and years, and, they worked real hard, and maybe they, American dream, got themselves a second home out at the beach or in the mountains or at a lake or something like that. And so they're thinking to themselves, well, the kids are out of college and, retiring. It's time to sell our primary residence in the suburbs that we've owned for 30 years. And, we don't know exactly where we're going to go, but the beach seems real nice, and we got a house there, so we're going to go ahead and just hit the beach. Boom. So, sell their house here in the suburbs, exclude a little gain, maybe all of it. Maybe they didn't make $500,000. Maybe they did. Maybe they paid a little taxes, whatever. Okay? And they move into their second home at the beach. And they're there for, maybe 3-4 years. And they think, this beach house is nice, but it's kind of big. Maybe it's kind of far away from our loved ones. We'd like to be back closer to everybody. Maybe we want to downsize. Maybe it's too small. Maybe you want to upsize. Whatever the reason. So you go ahead and you sell it and you think to yourself, well, we've been living in it 2 or 3 years, and we're a married couple, and we made, a bunch of money on it, we're going to be able to exclude the full $500,000, because, hey, we owned it definitely for more than 2 years, and we definitely lived in it for at least 24 months out of the 60 months prior to selling it. We should be able to get the full gain, right? Maybe. Maybe not. Okay? First of all, when was the last time you did it? So if it was more than 2 years ago when they sold their house in the suburbs, all right, they're golden. They can do it again. But here's the deal. They had to have been using that primary residence, that second home, as a primary residence, either prior to 2008, okay, or they would have had to have moved into it in 2008 for it to sort of be outside of this weird, wonky rule that came into play in 2008 and 2009, which says that in order for a second home to get any type of treatment under the Section 121 for gains exclusion, you have to calculate what's known as periods of non-qualified use. What's a period of non-qualified use? Well, it's any period of time, months or years, when it wasn't a primary residence. And you have to take that amount of time and the amount of time it was a primary residence, and you have to compare it to the total number of months or years of ownership, and you come up with a fraction or a decimal or a percentage of the full $250,000 or $500,000 exclusion that you're entitled to. So let's give a real good example, a real easy example. Let's say you own a property for 10 years. It's a second home, okay? And after 5 years of ownership of it being a second home, you move into it as a primary residence and you live there for another 5 years, okay? At the end of that 5-year period, you've owned it for 10 years, you decide to sell the property, and you're a married couple, and you make $500,000 in profit when you sell it. Congratulations. But you think to yourself, okay, well, I lived in it for 2 out of 5 years prior to sale, or 24 months out of the 60 months prior to sale. I should be able to exclude the full $500,000, right? Nope. You see, what I have to do is I have to look at your situation and say, well, you owned it for 10 years. 5 years it was a primary residence. 5 years it was second home. You only owned it for 10 years, but you used it half the time as a primary residence. You only get half, in this case, of the $250,000 maximum exclusion, meaning as a married couple, they're only going to get $250,000. If it was a single person, they'd only get $125,000, half of the $250,000, okay? So they're going to pay some taxes when they sell the second home, even though it was primary residence for 24 months out of the 60 months prior to sale, okay? So you see there's some trickiness here. There are also some rules about certain government employees, and there are rules about certain members of the military, active duty members of the military who are tasked away from their tax home. They're allowed to actually suspend the 5-year look back period for up to 10 years. So they can kind of put it on hold, move out, and then they can be gone up to 10 years, and then they can sell it at the end of the 10th year. And then what they're allowed to do is say, okay, well, we're going to basically look back 10 years, and then we're going to start the 5-year or 60-month look back period from the beginning of that, first year of the 10-year period. So in theory, a member of the military, foreign service, certain diplomats, members of the uniformed health corps and things like that, they may be in the intelligence community too. They may actually have more like a 15-year kind of look back period, where they could go back 15 years and find the 24 months, in theory, okay? Seen that, actually had an example of that just very recently. So there are implications. Even if there's no tax, there's still, again, reporting requirements. And like I said, most of the people that come to me, they haven't made enough profit to pay any taxes. If they did, well, listen, you owned it long enough. Long-term capital gains aren't that big a deal. I mean, they're one of the lowest tax rates you can pay, so it's not that big of an issue. I mean, paying any tax is kind of sucky, especially on your primary home. It's really sucky, but it is what it is. You made some money, and, the whole point is make sure you're getting there, grabbing and capturing all the deductions, all the real deal improvements. Sit down, look at it. And if you're thinking about buying a personal residence now, you're thinking that this is something that, you're going to be having to deal with down the road, make sure you're saving your documentation. Make sure you're saving invoices, some kind of a binder or something for all the big major improvements you make on your home over the years, so that when it comes time to sell, if you are in a pickle and you have made more money than the exclusion would allow you to exclude, that you've got this binder, or you've got a file, or you've got a stack of paper that you can reference to help you deduct against that gain and potentially pay less in taxes, because there's nothing worse than paying taxes except for paying taxes that you didn't need to pay. So, all right, well, that wraps it up for today. I think I got in under the 15 minutes here, so that's really great. Thanks for watching. Again, don't forget to like, subscribe, definitely leave a comment. Again, like I said, I reply to and answer all comments and read them all. Thanks for watching. Have a great day.